G'day. Welcome to a new episode of This is Investing. I'm Vince Scully, founder of LifeSherpa Invest. Many of you will know me from the Money podcast or Retire Right, and of course the campfire chats that Glenn and I have done over the years. So, new host, new beginning. I want to start back at the beginning of investing, bust a few myths, present a bit of evidence. Think about it as the rigor of our deep dives in a much more digestible time slot. So, this is investing. Let's crack on. And we're back. So, of course, none of this can happen without your input. So we're very keen to take your questions. If you have a question for me or the podcast generally, you can pop your questions in the Money group and make sure that you tag me. So let's crack on with the important topic here. And today I want to start with the why of investing. And once you get your why together, often the what and the how become much easier to deal with. And investing is really about separating your spending and your earning over time. That's either probably the most important one is saving for retirement, where over your working life, you've got to turn your human capital, your ability to earn an income, into financial capital before you're either unable or unwilling to work. And then the second category is where you're saving to spend something, whether that's buying a home, paying for your kids' education, your kids' wedding, or a big holiday, whatever it is. Either way, you're giving up spending today in order to spend more in the future. And the big barrier between you and the future, of course, is inflation. And money under your mattress is losing purchasing power every day. This gets a bit lost sometimes, but if you go back 40 years ago, when I first moved to Sydney, the median house price was $85,800. It cost 30 cents to mail a letter. I'll explain what a letter is in another episode. Potatoes were 79 cents a kilo, and petrol was 46 cents a litre. Even in the shorter term, since the Olympics in Sydney, the value of a dollar has roughly halved. So it takes $2.03 to buy what would have cost $1 back then. And that's been in a period of fairly mild inflation. And so for those of you who are watching on YouTube, here's a graph of inflation since 1947. The significance of 1947, that's when publishing CPI started in Australia. And what you'll notice on the graph is that it's averaged about 5% a year. That means it's going to double every 14 years. But in the 1980s, we sort of worked out what was going on, and the RBA started to target inflation. And so their target band between 2% and 3% is shown on the graph. And since 1993, inflation has moved in a fairly narrow band, but it's been above the range as often as it's been below the range. So it's about a third in each time. But the big spikes that we experienced beforehand are largely in the past because we've actually worked out what causes inflation. So looking back, you get this massive spike in the mid-50s, which headed north of 20%. That's a very alien experience to most modern Australians, but that was caused by a massive spike in demand for our wool to clothe the troops in Korea, and that income led to big consumer spending, led to inflation, and that was an economy that was already near full employment, and it took the government a long time to react to that. And the horror budget of 1951 is what took to slow that down. Pretty mild stuff through the 60s. 70s and 80s, we had the big spike, which was long, not as high as the 50s, but long and prolonged. And that was sparked by the oil price shock of 1973. And it really took until the very early 90s, the recession we had to have in 1991 to put the nail in the coffin of that inflation. But today, relative control might not feel like that in the light of the last couple of years, but generally it's been under control. But to replace that dollar of buying, which now costs $2.03, if you'd put the money in the bank, you'd have earned $3.02 before tax. So that's not buying you very much. So having introduced the concept of inflation and why, therefore, you need to invest, let's take a break and we'll be right back after this.
This is Investing is brought to you by Life Sherpa Invest. If you want your money to work harder and not just sit in a savings account earning crumbs, check out Life Sherpa Invest. Choose from 4 risk-based portfolios like Everest 90 with 90% in growth assets. Long-term, low-cost and built for people who are after serious returns. Invest from $5K today at lifesherpainvest.com.au/invest and start climbing.
And we're back. So investing is really about preserving and enhancing the value of your savings. The more you can earn from your money, the less you have to set aside from today's income to pay for tomorrow's spending. And that brings me to what you can expect your money to earn. So for those of you on YouTube, here's a graph of what you could have expected your money to earn over the last 25 years. And for those of you on audio, what this means is that $1 invested in the ASX 200, that's the 200 largest shares on the Australian Stock Exchange, would have grown to $764. The same dollar invested in the S&P 500, that is the 500 largest companies in the USA, would be worth $615. And if you'd invested in shares from the rest of the world, which in this context includes the US, but it's the rest of the world as well, you would have ended up with $468. Bonds, as we'll see in later episodes, delivered somewhere between the cash return and equities returns. And bonds, briefly, are loans to governments and corporates. And the best measures of these is the Bloomberg indexes. They may not roll off the tongue as quickly as the S&P 500 or the ASX 200, but the Bloomberg Global Aggregate Bond Index hedged into Australian dollars would have delivered you $380, and Australian bonds dragged up the rear at $311. Now, this result might surprise those of you who've come to investing recently. Anyone who spends as much time on Reddit as I do will be convinced that the USA is the only place to invest because it's outperformed just about everywhere else in recent terms. But whilst that might be true over 5 or 10 years, it's not true over 25 years, and it's not true over 125 years. Markets come and go. The last time we had a market as dominant as the USA is today, where it makes up 2/3 of the world's equity indexes, was Japan in the late 1980s. Between 1970 and 1990, Japan delivered a return twice that of the rest of the world. So $1 invested in Japan in 1970 was worth more than $50 by 1990. Hold my beer, Facebook. While the rest of the world would have given you just $10. That's a 5x return. But on the other hand, $1 invested in Japan in 1990 would be worth just shy of $2 today. So markets do come and go. Now, I'm not suggesting that the USA is the same as Japan in 1990 or that we're about to see a massive crash, but history does have a habit of rhyming, even if it doesn't repeat. So don't panic, but it is just another reminder that diversification matters and recency bias is a curse. It also highlights the dangers of hanging out on Reddit, and we'll come back to this theme in future episodes. These might just look like numbers on a chart, but they do have real impacts on your results and on your future. So if you take a 30-year-old today who saves 10% of their income, if they can earn 7% return and retire at 65, they could replace about 60% of their pre-tax, pre-retirement income. But if your savings only kept pace with inflation, you'd have to save closer to 50% of your income to achieve the same retirement income. And when it comes to investing, there are really 3 levers that you can pull, and that is how much you save, how long you wait, and the return you expect, and by corollary, the risk you're prepared to take. You can usually pick any 2 of these, and the third then falls out of that equation. But not all combinations are feasible. And broadly, the less risk you're prepared to take, the more you have to save or the longer you have to wait. But the more you expect return to do the heavy lifting, the more risk you have to take and the more variability you should expect in your outcome. That may or may not fit with your goals. So if you want to save $1 million by age 60 and you start at 30, if you earn 7%, you need to save $9,500 a year. If you earn 10%, you need to save $5,234. But if you only have 20 years, you'll need to save $14,880 at 10% or $21,535 at 7%. If you can only save $3,000, you'll need a return of 13% over 30 years or 22% over 20 years. That is all highly unlikely. And so in future episodes, we look at the implications of aiming for that higher return. So that might seem a little bit of a dull introduction to investing, but getting your why together is critically important to knowing what to do and so that you can focus on making the decisions that matter. I see a lot of people focusing on which broker I should use or which ETF I should buy. These are all second-order decisions after you've made the fundamental one about what am I trying to achieve here. And so in future episodes, we're going to get onto the more exciting stuff about how you actually go about doing that. But it is important to understand what you're trying to achieve, because only then can you answer any of those other questions. And that's what we're going to do in future episodes. So for now, I'm Vince Scully. This is Investing. See you next time.
Thank you for listening to This is Investing. Any advice is general financial advice and does not consider your objectives, financial situation, or needs. You should consider whether the advice is appropriate for you before acting. Always read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs before buying any financial product. Vince Scully is a representative, and Simo Interactive, Pty Ltd, and Glenn James are authorised representatives of Money Sherpa Proprietary Limited, which holds Financial Services Licence 451289. Thank you for watching, and remember, if you want to get more out of your investing, The Quick Start Guide to Investing, it's a book that we've written all around investing. You can have a look at this. There's a link in the show notes. Thank you for your support. And if you want further investing fun, The Quick Start Guide to Investing, as endorsed by Vince, obviously, is available wherever good books are sold, or there's a link in the show notes to get your copy today.